Hello out there in cyber accounting lands. Professor Ebert here to help you master it quick. In this session, we'll look at the accounting for stockholders' equity. We'll look at what happens when the company sells shares of stock, why they might choose to do so, what happens in the case of dividends, both cash and shares of stock, dividends, and what happens if the company repurchases the shares, either to retire them or to take them into the treasury for a while and with the idea of letting them back out later on. Now, why would companies sell shares of stock? Big difference between bonds and stock. When we were looking at bonds, we were, of course, working in the liability section. There were bonds payable, there was interest payments on them because there was a loan that was covered by the bond contract. But those folks did not own the company. They were creditors. People who buy shares of stock are buying little tiny ownership shares in the equity of the company. So they are owners. Big difference. There's no debt involved. They haven't lent any money to the company, so they're not going to get any interest payments. They might get a dividend payment, but the dividends have to be declared by the company each year. They're not guaranteed, not even on preferred stock, which we're going to look at in a couple of minutes. Now, why would people do this? They do it in the hopes that as the equity becomes worth more, so does the portion that they own. Remember, equity is another way of looking at the net worth of the company. If you rewrite this a little bit, the equity is the net assets. So as that part becomes worth more, so does the portion that the shareholder owns. If an investor had put $1,000 into Microsoft shares in 1985, 15 years later, they'd have had almost $170,000 with share splits and the continued appreciation in the share price. An investor who put $1,000 into America Online back in 1989, about 11 years later, they'd have had nearly $100,000 for the same reason. Now that is appreciation. Bondholders can't get that. When the bond matures, the best the bondholder's going to get is they're going to get the face value of the bond back. Now they might make a gain if they bought the bond at a discount possibly, but they're not going to multiply their money the way that folks who buy shares of stock might be able to do. Now that's the good news. The bad news is the reverse is also true. If we buy shares of stock in a company and the company becomes worthless, goes bankrupt, so does the portion that we own. So it's risky. Bonds were much, much safer. Stock is a much riskier investment, but risk will follow the rewards. The more the risk, the more the potential reward, which is why shareholders buy shares of stock. Now, there are actually two types of stock available. What are called preferred shares, not every company has. They have to get the board of directors to approve having that class of stock. But if they do, it means that the preferred shareholders get their dividend before the common does. Still not guaranteed. The company doesn't have to declare the dividend, but if they do, preferred is paid the dividend first. In return, they don't get any voting rights. Common shareholders, every company will have. Now, shares of common stock, if there aren't any preferreds in front of them, they get the dividend right away if it's declared. If there are preferreds in front of them, they got to wait till the preferreds are paid, and then they get the dividend second. In exchange for that, the common shareholders get a vote, typically one vote per share. How a hostile takeover happens is somebody gets control of enough common shares to vote the board of directors out and vote themselves and their friends in. Now, bondholders couldn't do that. Bondholders didn't have any votes. So if we don't want to get kicked out, we might choose to raise our long-term money by issuing bonds. But as we saw in the session on bonds, we also have to issue interest checks 2 times a year to the bondholders for as long as the bonds are out there. If we go the route of stock, we don't have to pay anybody any money back. We don't have to write out any interest checks. But do we have a bunch of new owners who are looking over our shoulder as we operate the company? We do. Can they come to the shareholder meeting every year and tell us how much we suck and how much our product sucks? They can. So that's the story on stock ownership. We're cutting in new owners. They may have a lot to say about how we operate the company, and we are cutting up the value of the ownership in the company. So those are things that go into the decision as to whether to raise long-term money with shares of stock or raise it with selling bonds instead. In this session, we're going to look at the accounting issues that are connected with selling shares of stock. If you remember our session on journal entries, when the company sold shares of stock, the cash account went up and the stock account also went up. Now that's basically what happens, except we use a value called par value to help us track the number of shares. That's all it does. When we were talking about bonds, par meant the face amount. In stock, par is just an amount to track the number of shares. So let's look at how it would work. Let's say a company sold 1 million shares of $1 par common stock at $5 a piece. Okay, the investors who bought the shares pay the company $5 million, so that's the debit to cash, picking that piece of it up. The stock account will go up, but we're using that $1 par to track the number of shares. So $1 times a million shares, $1 million will be credited into common stock $1 par, and the other $4 million will go to an account called paid-in capital. Paid-in capital is an equity account, just like common stock, works the same way. Credits are an increase, debits are a drop. So it's just there to catch the extra money. So if this company were to look into their stock account one day and see $1 million, if it's a $1 par, 1 million shares had been sold. That's the only job par has. Now, some states have a minimum capital law, and companies avoid using the word par, so they use the word stated value instead, and it just pinch hits for par. Does the same thing. Now, if the company also sold preferred shares, the same idea is at work. Let's say that this company here sold preferred stock with a $50 par and received $750,000 cash. The debit to cash will be what the investors pay. $50 par is being used to track the number of preferred shares. So you can see it's 10,000 shares at $50 a piece. 500,000 is going there. And once again, we use paid-in capital, but with the word preferred added, meaning it pertains to that class of stock, to catch the rest of the money. This is done only to help the company track how many shares are out. Now, whether the shares are still outstanding or not will depend upon whether any were repurchased, which we're going to look at a little later on. But if there aren't any repurchases, those shares will stay out there for sometimes. That's the only stock issue that's ever been done, and it stays like that for the rest of the time the company's in business. Other times there'll be events which will change the number of shares, which we will talk about in a few minutes. There are two possible reasons why a company might repurchase shares. One is in the case of a stock retirement. In those cases, the company doesn't want to be publicly owned anymore, and they want to take the ownership private. So this is sometimes referred to as a tender offer. They will tender or offer money to the investors for the shares, and then the investors have the option of reselling the shares at that point. Now, if the shares are going to be canceled, the investors kind of have to take the tender offer, or else they won't get anything at all. So the company will buy the shares back. An entry to do that is sort of the reverse of the entry when they were sold. The company is going to write out a check, so there'll be a credit to cash. They're going to debit out the stock account, debit out the paid-in capital, and then the difference, what would be like a gain or a loss on it, is going to affect the company's retained earnings account. But that's kind of a once-and-out thing. That's a permanent retirement of that class of stock, which is not often seen. What is seen much more often is what is known as a treasury stock transaction. Treasury stock means the company is buying temporarily some of their own shares back with the intention of releasing them back to the market later on. Now, what I'm going to demonstrate here is called the cost method, wherein the company will use the price that they pay to buy the shares to account for that particular block of stock. Let's say a company decides on July the 1st, 2015 to repurchase 10,000 shares and pay $7 a piece. All right, so what they would do is debit the treasury stock account for $70,000, which is shown here, and then the credit side is the company paying the cash to buy the shares back. Now, from the way this account is being used, it might seem that treasury stock is an asset account. You see it being debited there. That's not the case. What treasury stock is a contra equity account. That's why it's working the opposite way. We're debiting it instead of crediting it to increase it. So if this company made a balance sheet right after they did that, they would show the preferred stock, the common stock, how many shares are authorized and issued, and then the paid-in capital accounts. And then down the bottom, they would say less cost of treasury shares. So it's a reduction of stockholder equity whenever a company does this. Now, why do companies do this? They might be doing it to try to help the earnings per share, which we'll see in a few minutes. They might be doing it to gain control of the votes on those shares. One way of making it more difficult for somebody to take over the company might be to take control of some of the shares so that you can vote them. Now, while these shares are in the treasury, the votes belong to the company, and of course they don't receive dividends because the company would be simply paying themselves. Now that Smith has these shares, they're not outstanding shares anymore until Smith resells them. And so Smith has the votes, and Smith doesn't have to pay any dividends on them. Smith also would not use the shares to compute earnings per share because they're not outstanding shares. To compute earnings per share, we'll take the net income, minus out the dividends on the preferred class of stock if there are any preferred shares, and then divide the remaining amount by the average number of outstanding common shares. This will result in a slight improvement in earnings per share, and is sometimes why companies buy back treasury shares. When the company reissues the treasury shares, they might be reissuing them at a different price than they paid to acquire them in the first place. Now remember, we were looking at the company buying a block of 10,000 shares at $7. Under the cost method, we have to stay with that $7 cost. Now, let's suppose that the company reissues 5,000 of the shares and is able to get $10 a piece for them. And they do this on August the 1st, 2015. All right, the entry to do that is going to bring in cash, of course, from the investors who buy the shares. They're paying $10 a piece, 5,000 shares, so that's $50,000. We're going to lower the treasury stock account down using the $7 cost. $7 times 5,000 shares is $35,000, which is a credit to treasury stock to reduce it down. So you can see this transaction is going to actually create some paid-in capital. It's the difference between the $10 reissue price and the $7 cost. $3 times 5,000 shares is $15,000. Now that's if they reissue at a price above what they paid. Now, because of the bad market conditions that prevail a month later, I'm going to show you what would happen if the price was only $3 that they could get. Now, this is for the purpose of illustration. Naturally, the company's not going to sell them if the market's that bad. They'll wait until it improves. But I want to show you what would happen if they were reissued at a lower price. So suppose we sell the remaining 5,000 shares in that 10,000 block, and we only get $3 a piece. All right, we're going to get cash on September the 1st, $15,000, $3 times 5,000 shares. Now, we're going to lower the treasury stock account for the remaining 5,000 shares using the $7 cost. So there's $35,000 credit over there. So you can see I've got to take up $20,000 worth of stuff on the debit side. The first thing it does is it wipes out the paid-in capital that was created by the earlier sale. So there's a debit to paid-in capital for $15,000, but that isn't enough to square the entry up, so now I've got to go to retained earnings for the other $5,000. If all of the paid-in capital that had been created by previous treasury stock reissues has been exhausted, then retained earnings has to be used for the debit part of that entry. So just check your money, make sure you got the same on both sides. $35,000 on the credit side, 15 and 15 and 5 is $35,000 on the debit side. So that's what happens in both cases, a reissue above costs and a reissue for less. When a corporation declares a dividend, there are 3 dates, 2 of which will require a journal entry and 1 of which will not. Let's use the illustration of a company with 10,000 shares of 5% $50 par preferred. I'll use that as an illustration how to get the amount per share on a preferred dividend. And then at the same time, we can use it as a means of demonstrating the journal entries that are needed. The declaration date is the date the company decides to declare the dividend. It's pretty much an irrevocable decision. So once they do that, and it's done by action of the board of directors, the die is cast. There's going to be a dividend. Now, what the company wants to do is determine the amount of money involved. If it is preferred shares, I'll show you how to get the dividend. You take the par amount and multiply by the dividend rate. 5% is the dividend rate. The par is $50. So 5% times $50 is $2.50 for each share. Next, we've got to see how many shares are out, 10,000 shares. So $2.50 multiplied by 10,000 shares is $25,000. So our entry on the declaration date is a debit to the dividends account. Some people debit retained earnings. You could do that if you want to. Debit $25,000 to dividends or retained earnings, and the credit is going to dividends payable for $25,000. You might say, well, why don't you credit cash? We haven't paid it out yet. That's going to come up a little later on. So right now, there's an obligation that exists to pay the dividend, which is why we're using the dividends payable account. So declaration date, journal entry. Record date, there is no journal entry. The purpose of the record date is to determine who's supposed to get the dividend check. Now, it's whoever owned the shares on the record date. So if you own the shares on the record date and I buy them from you the next day, you get the dividend check, I get the next one. So it's for the purpose of deciding who's supposed to get the dividend check. The payment date, there's a journal entry because we're actually sending the checks out. Now, in this example, I made it a month later, which is very, very common. It might take a month to find out the changes in ownership that have happened on the shares. People do buy and sell the shares, so there could be a new owner since the last dividend date, and it'll take a little bit of time to find that out. So that's why the company will give themselves a little time to find out the new owners they're supposed to mail the check to. And then on the date of the payment, they're going to discharge the dividend payable liability by debiting it out and then credit cash for the same amount. If it were a common dividend, usually you'd be working with just an amount per share. After the preferreds have been paid, the rest of the money available for dividends can go to the common shareholders. Now, that doesn't mean that the common shareholders necessarily get less. Remember, that 5% of $50 par is all that the preferreds will get. That is sometimes called the preference amount. So the preferred shareholders get the preference amount, and that's all they get. So if the company has an exceptionally good year, the common shareholders can actually end up getting more per share than the preferreds. It's just that the preferreds get the dividend first. When the company gets the money together for the dividend entries, they have to be mindful of events that might have changed the number of shares. Now, in the case of preferred shares, the only thing that'll change that basically is selling additional preferred shares or possibly retiring the preferred share class, which is very, very, very unusual. Most of the action is in the common share class. There are a number of events that can change the number of outstanding common shares that we have to take into consideration if any of these things have happened since the last common dividend was paid. A stock split pertains to common shares, and that's where the company increases the number of shares, which is the case most of the time, or decreases them in the case of a reverse stock split. If the company effected a 2-for-1 stock split, they give the investor 2 new shares for every old share that the investor surrenders. Now, that event will increase the number of shares, but it does not change the overall stockholder equity. When the stock split happens, the market price will temporarily drop in half if it's a 2-for-1 split, but the book value, which is the common stockholder equity divided by the number of outstanding common shares, will drop in half and stay that way. So does the par value drop in half. So if we used to have 1 million shares with a $1 par and we do a 2-for-1 stock split, now we got 2 million shares with a 50-cent par. That's all that happens. But it does increase the number of shares that are out. Options and warrants are given to key employees as a means to motivate them to produce more and operate the company better by giving them the chance to purchase the company's shares at a reduced price at a future date. So if they've operated the company well and the company's price is now $50 a share and they have the option to buy it at $25 a share, they'll step into a nice capital gain when they exercise the options. But did it also increase the number of shares? It did. There are more shares out there. Warrants are a type of a derivative security which, when they are purchased and exercised, can create additional common shares. There is such a thing as a convertible bond that can be swapped for shares of stock, and that, of course, would increase the number of common shares. A stock dividend, which we're going to look more closely at in a few minutes, produces a dividend that's in the form of shares of stock rather than cash, so naturally the number of shares is increased. Treasury stock, as we saw, goes the other way. It reduces the number of outstanding common shares. So we have to look and see if any of these things have happened since the last common dividend so that we can compute our dividend on the correct number of shares. When the corporation decides to have a dividend in the form of shares of stock, we refer to it as a stock dividend. And of course, that's an event that's going to increase the number of shares. Now, you'll see it does not change the total stockholder equity because in a stock dividend, we're going to take money away from retained earnings and send it into the stock accounts. Now, how much money? Depends on the size of the dividend. Up to 20, some people use 20, some people use 25, so that's why I've got both numbers up there. If your company decides to have a stock dividend up to 20 to 25% of the shares, it's considered small, which means that we figure the money out using the market value of the shares on the declaration date. Above 25% is considered a large stock dividend, and we use the par value instead of market. So the same thing's going to happen. We're going to take money out of retained earnings and put it in stock accounts. The only difference is how we determine the amount. Now, let's illustrate by using, on 8/1, let's say our company decides to do a 10% stock dividend, which is talking about the percentage of shares they're going to give out. All right, so we need to know how many shares are outstanding. On that day, there's 100,000 outstanding shares, let's say, and market price is $9. And it's going to be distributed on August 15th. Okay, here's what will happen. This will be basically our declaration date entry. First, we've got to get a handle on how much money it should be. Okay, 10% is clearly in the category of small, so we need to use the market value. $9 times the number of shares we're going to create. 10% times 100,000 shares is 10,000 more shares. So we're going to reduce retained earnings with a debit entry for $90,000. The credit side is going to create right now what's called common stock distributable. We're using the par, which is $1, and we're taking 10,000 shares times $1, which is why we're using $10,000 there. Now, why didn't we call it common stock $1 par? Because the shares haven't been handed out just yet. That's going to happen on the 15th. So we credit common stock distributable for 10,000. So it created paid-in capital when we did this. It will. The market value is almost certainly higher than the par. The par is usually a penny or a dime or a dollar, something that's real easy to divide with. So the market value is almost always higher than the par. So in a small stock dividend, it will, in most cases, create paid-in capital, such as it did here. All right, so that was our declaration entry. You can see why the total's not going to change. Okay, that's an equity account. We reduced it. Those guys are both equity accounts. We increased it for the same amount. So the total stockholder equity is going to remain unchanged. All right, this would be like the payment entry, except we're not paying any money. We're handing out shares of stock. So what we do is we debit out common stock distributable on the day we're handing the new shares out and replace it with common stock $1 par. So as of August 15th, those new shares are live. They can vote, they can receive dividends, all those rights that common shareholders have. Before that, they were sort of in limbo here in the common stock distributable account. They couldn't vote and couldn't get dividends yet. But when they're handed out, they can. So to summarize, the events that will change stockholders' equity, the one that will reduce it is a cash dividend. When a company pays a cash dividend, the retained earnings does drop. Stock split does not change the total stockholder equity. It remains the same, the total, before and after. What it does change is the number of shares that are out. Like we said, if we had 500,000 shares with a $1 par and we did a 2-for-1 split, we'd have 1 million shares with a 50-cent par. A reverse split just goes the opposite way. The number of shares is less, the par is higher. So the total stockholder equity amount remains the same. There aren't any journal entries necessary for a stock split. It's just more pieces of paper out there with a lower par value. A stock dividend does not change the total. We took money away from retained earnings and we put it into the stock accounts. It does increase the number of shares, though, as we mentioned earlier, but the total stockholder equity remains the same. So that'll win you a bar bet someday if somebody asks you, does a stockholder equity change on a stock split or a stock dividend? And you'll know the answer to that question, that it doesn't. So this is Professor Ebert checking out. See you next time.